Okay, hello everybody. Welcome to Crane Atlanta Mentorship. And in this video, we're going to do velocity banking with affordable housing. What's crazy is that I saw a news article about how in San Antonio, Texas, tiny homes, or there's this community of tiny homes that are essentially the rage, right? $160,000, one bed, two bath. Again, one bed, two bath, 661 square foot, and that's $242 per square foot. And take a look at this. These are all the sold homes in the area. I saw it in the news, and this is how it looks like. And so there are parts of the country where this is considered to be affordable housing. Now, real estate is very local, so there might be other areas in the country that unfortunately is not part of a big metro area where it's still affordable. Like one of my mentors, he actually has over 300 houses in the Midwest and is very cheap and actually controls has a controlling or is able to influence a market because he buys so many houses cheap. And you could see here, this is Danville, Illinois, where I got the screenshot here today, where you have a decent house, not like one of these tiny homes without a garage, that's only selling for $109,000. So I figured, why don't we pretend that we live in this low cost area? Although I know that, the houses like these are kind of like a myth, kind of like a dinosaur in many areas of the country. But let's just assume that, hey, the purchase price is real low and we'll do velocity banking and 100% financing, right? 100%. We're going to buy it for $109,000. And here's the thing that we got to remember, right? When it comes to loans and purchase prices, the lower the price is the purchase price or lower purchase price is way more important than the interest rate and the monthly payment, right? You have two loans that have the same monthly payment, where one is like $200,000 and I think at like 8% interest, and then $300,000 at 3% interest. I forgot the exact figures, but let's assume those monthly payments are the same. $200,000 at 8% interest is way better than $300,000 at 3% interest. Okay. So let's go ahead and imagine that we're going to go ahead and buy this house, this low cost house, affordable house, and do velocity banking with all of our, income and debt and all that, right? So what is velocity banking? It's just basically a debt payoff strategy using lines of credit as our main tool. And there's really two things that we got to do for velocity banking. Number one is the budget. And number two, we just need a line of credit as our main operating account. And you might be thinking, what's a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again, right? So if you have a credit card, that fits in that category. There's also other types of lines of credit like personal home equity line of credit. And in this example, we'll just assume we have a personal line of credit. Okay. And think about it as like a credit card, but you can use it to pay anything. Like you can use it to pay other credit cards, loans. You can't do that with credit cards, but with the personal line of credit, definitely you can. All right. So now we have $4,000 of income. Again, lower cost area, um, cheap houses, $109,000, only $725 a month. That's crazy. You have $725 a month. Oh my goodness, I'd love a house like that, right? All right. So we have two credit cards, a student loan, auto loan, mortgage, and we see that our general expenses are more than our debts. Yet, when we've done this situation many times, especially in higher cost areas, the mortgage is usually like the biggest expense of everything. But $725, I'd love that. Love to get a house like that for very cheap, $110,000. Love it, and you could just finance 100%. And if you have a decent salary, it's one of the affordable places that you can live in. Let's just go ahead and do velocity banking. And what's the two things that we always assume with velocity banking? Same income and zero savings. Oh my goodness, zero savings. That would freak out a lot of Americans, right? That zero savings. But we know velocity banking. We know what we got to do, and let's just assume that we have a I don't know, $15,000 line of credit. Now, I know what some of you are thinking, 15 grand, that's insane. That's what I thought too, but now I have $258,000 in available limits and lines of credit, right? So, something that everybody's at their own level at their own stage, right? So something that may seem insane to you now, it'll be like, "Oh, it's totally normal." Yeah, I would say, "Oh yeah, $258,000 in lines of credit." Right? $258,000. It's my magic number. Next month it'll be like 260 something. Okay. Just as, no, not really, because they'll probably deny me because I have too much credit right now. All right, so now what we're going to do is do quick calculations. So here's what we're going to do, right? We're going to just do some debt transfer, and we're going to transfer these credit cards, 15 grand, into that line of credit. So it's basically almost like a balance transfer, but um, without that balance transfer fee, right? So let's go ahead and do that. And bam, bam, right? 0, 0, because this debt is essentially paid off. And now we went from 1,300 or 1,250 to 1,775. If we just add a few more cents, we're going to have that special number, 1,776. But for today's demonstration, we're unfortunately going to use 1,775. All right, so now let's go ahead and calculate how we would do velocity banking. So what's the basic strategy? Income into line of credit, expenses out. And you might be thinking, it's that simple? Yes, it's that simple, right? So income in, your entire income, your $4,000 paycheck, and does two things. It satisfies the minimum monthly payment, right? It satisfies the minimum monthly payment, and it decreases the interest because you're putting your entire paycheck in, and the average daily balance, which is used to calculate the interest, is going to be lower than it normally would be, right? So let's go ahead and calculate the next month's balance, which is the previous month's balance plus the previous month's interest minus that cash flow right here, right? No savings, but we have that cash flow. Okay, and then now we got to calculate the interest. So let's go ahead and do that. So let's go ahead and use not the sum. There's one called interest, whoopsie, or average, I'm sorry. So let's go ahead and look for average. We're going to take the average of these two numbers because the interest is calculated by the average daily balance. So we're going to do is multiply it by 1.5 divided by 12. And then the interest that's essentially the interest for the month. And then now we're going to go ahead and pay this off, just copy and paste, right? And wow, it only took us 9 months to pay off this 15 grand of debt. Amazing. All right, so let's go ahead and do that. And we'll go ahead and put this as a milestone. And so now let's go ahead and put a milestone right here. We'll put this as took us 9 months to pay off these two credit cards. So let's go ahead and do this. So 9 months, 15K. Dang, we paid off the debt pretty easily. Okay, so now next is we have these 3 loans, and how do we figure out which debt we're going to pay off, right? Is it the student loan first, the auto loan, or the mortgage? So there's 2 ways to figure out which debt to pay off. We have to look for debts, the debt that has the lowest balance, highest interest rate, and highest payment, or we use something called the cash flow index, right? So if we take a look here, which one has the lowest balance, highest interest rate, and highest payment? Well, this one has the lowest balance, this one has the highest interest rate, and this one has the highest payment. But I don't know if I'm going to pay off my mortgage first. But let's use something called the cash flow index. And that one is actually a measure of your payment compared to the balance ratio. And that's going to determine which one to pay off. I have a feeling that we're going to pay off the mortgage first. But let's go ahead and check. So 10,000 divided by 103.64. And then this one is 22,000 divided by 395.31. And then this one is 109,000 divided by 725.18, right? And the whole point of the cash flow index system is that the lower the number, that's the one you want to pay off first. So as you can see here, we want to pay off the auto loan. Even though it's the lowest interest rate, if we pay this off first, that's going to give us the biggest cash flow compared to these other types of loans, right? So let's go ahead and do that, and we'll just follow the cash flow index model. So what we can do here is that if we go in here, right, we only have a $15,000 line of credit, and we don't have to put the whole thing in the auto loan. Like well, you don't have to. If we had a $25,000 line of credit, I probably wouldn't recommend putting that entire line of credit into the auto loan. So what we do is we're just going to use a velocity banking calculator right here, and this is provided by Renatus, and I'm a Renatus student, and this is where I first learned velocity banking from. So if you go into myrenatus.com, you could see that they have courses not only on velocity banking, but real estate investing, financial literacy in general. And again, they have this calculator if you're a student, and you can just put in the information right here. And so let's go ahead and put in the information of the loan, which is 22,000, 22,000. And what is the balance of the loan? I don't know. We have to check. So, and actually, that's the crazy thing. I probably didn't do this right because I didn't get the current balances of all the loans after, you know, after what is it, 9 months? Oh well, it's okay. So 22,000, car loan 5 years, and then 3%, and then so now this is going to be 395 point. No, actually, it's still going to be the same payment, but what is the balance after 9 months? So it's going to be 18 grand. Okay. So let's actually just put that right here. Okay. So the current balance right now is 18 grand, right? And the interest rate is 3%. At how many years? This is going to be a 5-year loan. And what is the payment amount right now? 395.31. Okay. And we're just going to just move pieces of the loan to the line of credit. They call it chunking, or there was another word for it, but I forgot what it was. But let's go ahead and do that. And just move the same amount as what our income is, which is $4,000. That's pretty much all we would need. $4,000, 15%, $4,000. And then what we do is add up the expenses of everything except the debt that we're trying to pay off. So it'll be this, this, and this. So let's go ahead and sum that up. Or we could do 1775.87 minus 395.31. Either way is fine. Okay, so let's go ahead and sum this up. Sum D10, D12, oopsie, 1828.82. Okay, how long does it take to pay this off? 8.8 months. 0.8 months or 0.8 years, right? So let's figure out how much 0.8 years is. So 0.8 equals 0.8 times 12. That's about 9.5 months, 9.6 months. So we'll just say I'll say 10 months, right? So we'll say 19 months to pay this off. And then so now it's 15K plus 22K, which is 37K. Excellent. Okay, so now let's tackle on the student loan. And heck, we could just let's figure out the balances after 19 months. So let's go ahead and do that. And this is going to be 10,000 at 10 years at 4.5% interest rate. Okay. And now what we're going to do is figure out what the balance is after 19 months. And take a look at this. It's not that much money. So 8,700. And what's our cash flow index at this point? 8,700.04 divided by 103.64. So 83.94. Okay, so if you know anything about the cash flow index system, it's actually telling you don't pay off the entire loan if if that number is a little bit too big. Now here's the thing: we don't even have that much interest either, but we can still just go ahead and pay it off and put into the line of credit, but we don't really get that much cash flow back. That's kind of the lesson of the story for this one. But we could still do it off with the line of credit, but I don't know if we want to do the entire thing or just put it in pieces. And we can compare both scenarios as well. So let's go ahead and do that, which is $10,000 student loan balance. Again, not that much because we were smart and we decided to go to community college instead of I don't know, some super expensive private school, right? So 8,700.04, interest rate is 4.5. Yeah, and 103.64. 103.64. Yeah, right here. So 10-year, 10-year student loan. And then let's just go ahead and put this in here. And now what is our new expenses? Our new expenses is essentially this is going to go to zero. Well, I don't know if it's going to go to zeros, but it's everything except for what we're paying off. So it'll be 1725.18. 1725.18, right? And so now that's zero point 0.4 years, okay? Now let's take a look at what happens if we put the entire thing into the line of credit. So you could see that's $129 of interest, 0.4 years, 8700.04. If we just put the entire thing in the line of credit, you could see there's a little bit of difference, but not that much, right? So you could put the entire thing into the line of credit if you want, or you could just do it in small chunks. Small chunks always wins just because it's resilient to the interest rate, and you're not, you're using it to prevent the segregation of income, and that's not something I talked about in this video, but I'll talk about in another video. Okay, so now let's go here, 0.4 months. So 0.4 months, how much is that? Or no, 0.4 years times 12, which is 4.8. So we'll just say 5 months, right? So now this is bam, 0. And 19 months plus 5 months is 24 months, which is going to be 47K because we paid off 10K. Now, we're going to figure out at 2 years what's the loan balance of this mortgage, this very affordable mortgage, right? So this is going to be what is it? 109,000, 109,000 for 30 years at which interest rate? 7%. So high interest rate, but it's an affordable price, right? And the monthly payment's not even that bad. So what if I had gotten this for like 3%? Look at that. That would be half. That's crazy. Crazy. Oh my goodness. Okay. So now we got this. And then, all right. So now at 24 months, what is the price? Or not the price, the ending balance. And so it would be essentially be this one right here, 2 years, right? We paid $1,200 of interest and $180 in principal. Amazing. So, all right. So now what we're going to do is just do the same thing, right? So amortized loans are a little bit different, especially if they're lower interest rate amortized loans. But I heard that there were HELOCs or lines of credit that are like 4 or 5% interest. And I think, and I'm going to have to verify this, if it's a first position home equity line of credit, and I might be wrong about this, it might actually go at a 4 or 5% interest rate, but I'll have to verify. All right, so what's the original balance, which is 109,000. So let's go ahead and put that number here, 109,000. What's my current balance? My current balance is this 108. Again, we only chipped off $1,000 of the loan. Oh my goodness. Okay. 7%. How many years? This is going to be 30 years. And what's the payment amount? The payment amount is 725.18. 725.18. Now, what's our new living expenses? It's just $1,000. We just pay everything or put everything except for the loan we're paying off. And bam, 3.5 years. 3.5 years, people. 3.5 years. So the way that we calculate this is we just 19 times 12 plus 3.5. And so, whoopsie, 19 divided by 12. Okay, so 5.08 years. So 5.08 years. And how much did we pay off? 156K of debt. Amazing. 5 years, lower cost area, somewhat decent income. We paid off 2 credit cards. We paid off our community college student loan. We paid off our auto loan. We paid off our mortgage. It only took us 5 years, right? In total. And that mortgage only took us about 3.5 years, right? Shouldn't take us 30 because that's a ripoff. And then now we can start investing, right? Because we're completely debt free and we have this huge, massive amount of cash flow that we could just put in our savings. And that's month 1, month 2, and we're going to be balling at the bank, right? So that's how and that's the end of the story for today. So we just paid off debt with affordable housing. There's a saying in real estate that the biggest mistake that you'll ever make is to overpay for it. And so we have to train ourselves to do the exact opposite of what most people do. Okay? All right. Well, have a great day, everybody. If you're interested in joining a group, go ahead and click the Google form link below for consultation regarding joining our mentorship group. Other than that, have a great day, everybody, and we will speak next time.